Applied Digital may be one of the most fascinating and intriguing AI infrastructure stories in the market today. Here is why investors cannot stop watching it. On the 2-year chart, the stock began at $3.98 and later closed as high as $49.65. That is a return of 1,147%, but that breathtaking rally is only half the story. Applied Digital is planning one of the most aggressive data center buildouts in the public market. It has signed 15-year leases representing 1.41 gigawatts of critical IT capacity and $36.2 billion of base term contracted revenue. At the same time, the company spent nearly $2.9 billion on property and equipment in fiscal 2026, and the remaining construction requirement could still be in the range of $11 to $14 billion. And here is the tension that makes this stock so entertaining to follow. Nearly 28% of its public float is sold short. So bulls see a future AI infrastructure giant, while bears see huge financing needs, dilution, and a valuation built on assets that are not yet fully operating. Applied Digital has transformed from a cryptocurrency infrastructure operator into a developer and landlord of large AI data centers. Its enormous leases make the growth opportunity credible. But after such a powerful stock price move, has too much of that future already been priced in? Let us find out. Let us begin with the chart. During the last 2 years, the stock experienced 10 separate peak-to-trough declines of at least 30%. Imagine that, 10 major drawdowns in only 2 years. The deepest came in April 2025, when the price fell from $10.65 to $3.44, a decline of nearly 68%. From that low, however, the shares later climbed above $13, producing a recovery of more than 300%. The second largest decline came after the May 2026 peak. The stock fell from $49.65 to $23.22, a loss of more than 53%. It has since recovered toward $30, but it remains around 40% below its highest closing price. This pattern tells you something important. APLD has repeatedly produced rebounds of 50, 100, 200, and even more than 300% after major declines. That may sound exciting to you, but please do not confuse a historical pattern with a promise. Each recovery depended on a new contract, financing milestone, construction update, or renewed excitement around AI infrastructure. At the current price near $29.70, the stock is above its 20-day moving average, but below its 50-day and 200-day moving averages. In plain English, short-term momentum has improved, while the medium-term trend is still repairing the damage from the sell-off. The relative strength index is close to neutral, so the stock is neither deeply oversold nor clearly overbought. You may find the short position even more interesting. The latest published data shows 72.7 million shares sold short, equal to nearly 28% of the public float. That can amplify losses when sentiment weakens, but it can also fuel a violent short squeeze when the company delivers good news. With beta near 5.7, this is clearly not a low-stress stock. On a side note, if you are finding this breakdown useful, consider subscribing to the channel and liking the video. Just a quick reminder, this video is not financial advice. Analysts are overwhelmingly optimistic, but the spread between their targets is a warning that nobody should ignore. Stock Analysis currently shows a strong buy consensus from 11 analysts with an average target of $74.23. The low target is $37.50, while the high target is $109. From a share price near $29.70, the average implies upside close to 150%. Wall Street Journal's research page shows a very similar average near $74, while MarketBeat reports a moderate buy consensus from 17 analysts and an average target of $68.15. TipRanks shows an average of $72.56 from 9 recent analysts. At first glance, those figures look extremely attractive, but here is the more useful way to interpret them. The range from $37.50 to $109 is enormous. The low target offers only a moderate cushion over the current price, while the high target assumes that Applied Digital can finance, construct, and stabilize a large portion of its contracted portfolio without destroying too much value for common shareholders. Applied Digital's market value is now close to $8.5 billion. Against fiscal 2026 revenue of $611 million, the stock trades near 14 times trailing sales. The forward price-to-sales ratio is around 11. Because the company remains loss-making under GAAP, a conventional price-to-earnings ratio is not useful. On current results, that valuation is undeniably expensive, but the bullish argument looks beyond current revenue. If all 1.41 gigawatts become operational, the $36.2 billion of base term contracts represent an average of roughly $2.41 billion of annual revenue across 15 years. Management expects mature site-level net operating margins in the mid to high 80s. If that target is achieved, the campuses could ultimately support more than $2 billion of annual stabilized net operating income. Now let us move to the financial statements, because this is where the story becomes both encouraging and uncomfortable. Revenue increased from $55 million in fiscal 2023 to $228 million in 2025 and $611 million in 2026. That is growth of 167% in the latest year and more than 1,000% in 3 years. But the quality of that revenue matters. In the fourth quarter, HPC hosting generated about $203 million. Only $44.1 million came from base rent. Another $52.4 million came from tenant fit-out services, with $6.5 million from tenant recoveries. Tenant fit-out revenue can make the top line look spectacular during construction, but it is low margin and does not repeat like rent. For the full year, Applied Digital recorded $270.6 million of tenant fit-out revenue against $58.1 million of related cost. That is only about a 5% gross margin. To understand the business, think of Applied Digital as an AI data center developer and landlord, not as a software company. Its customers generally bring their own servers and GPUs. Applied Digital secures the land and power, constructs the buildings, installs cooling and electrical infrastructure, operates the campus, and collects rent under long-term agreements. The HPC hosting segment is the centerpiece of the future. Polaris Forge 1 is leased to CoreWeave, an important NVIDIA-based AI cloud provider. Applied Digital has also signed several leases with the same unnamed investment-grade United States hyperscaler. The company still operates a legacy data center hosting business that primarily serves cryptocurrency mining customers. It can produce cash, but it is not the reason investors are awarding the stock an AI valuation. Chronoscale, the former cloud services business, was separated into a publicly traded company. Applied Digital retained close to 96% ownership at fiscal year end, so the accounting can still look complicated, even though management excludes parts of that operation from adjusted results. The most exciting headline is the contracted portfolio. 1,410 megawatts across 5 campuses and $36.2 billion of base term revenue. 3 leases signed with the unnamed hyperscaler during the latest quarter added 810 megawatts and $20.2 billion of contracted revenue. This validates demand, but it also creates concentration risk. More than half the backlog comes from that one unnamed hyperscaler. CoreWeave accounts for another large portion. Together, those 2 customer relationships represent most of the economic opportunity. Take-or-pay contracts provide protection, but customer credit quality, contract terms, and successful delivery still matter. Now, for the part that can easily be misunderstood, Applied Digital reported a full-year GAAP net loss attributable to common shareholders of roughly $249 million. You may see headlines saying the company became profitable, but those headlines refer to adjusted results, not GAAP profit. In the fourth quarter, the GAAP loss attributable to common shareholders was $110.6 million. Adjusted net income was $12.9 million. For the full year, adjusted net income was $36.1 million, and adjusted EBITDA was $107.2 million. The difference is important because stock-based compensation and other adjustments are real economic considerations for shareholders. Adjusted figures can help us understand the underlying operation, but they should not make us forget the dilution and financing cost required to reach scale. There was, however, a genuinely positive development. Operating cash flow improved from negative $115.4 million to positive $89.7 million. That is a major directional improvement. But before celebrating, look under the hood. Operating cash flow benefited from $220.1 million of stock-based compensation and a large increase in accrued liabilities. Stock-based compensation is non-cash in the cash flow statement, but it is not free for shareholders because it can increase the share count. Without that adjustment, the economic picture would look much weaker. Then comes capital expenditure. Cash purchases of property and equipment reached $2.87 billion. Subtract that from operating cash flow, and free cash flow was negative about $2.78 billion. So yes, operating cash flow turned positive, but the business remains extraordinarily dependent on external capital. Applied Digital says significant investment will continue through fiscal 2027, and management indicated capital spending of roughly $600 million in the next quarter alone. The reward for completing the build-out could be substantial. Contracted capacity is scheduled to come online through the second half of 2028, and the base lease portfolio averages more than $2.4 billion of annual revenue. The problem is that revenue arrives over 15 years, while construction bills arrive now. To fund the gap, Applied Digital is using a combination of secured debt, partner capital, preferred equity, and common equity. Macquarie Asset Management has agreed to provide up to $5 billion of preferred equity financing for eligible projects. That support reduces Applied Digital's immediate common equity requirement, but Macquarie receives preferred returns and an economic interest in the underlying HPC subsidiary. In other words, not every dollar of future campus value belongs to APLD common shareholders. The balance sheet held $1.6 billion of unrestricted cash and about $2.6 billion of restricted cash at the end of May. You may look at the combined figure above $4 billion and feel comfortable, but restricted cash is not the same as money sitting freely in the corporate wallet. It is generally tied to construction, debt service reserves, lender requirements, or other specified purposes. Long-term debt principal was above $5 billion, with substantial future interest and a large maturity concentration later in the decade. Liquidity does not look like an immediate crisis, but the company's success now depends on continuous access to capital and disciplined project delivery. Existing shareholders should pay close attention to dilution. Shares outstanding increased from roughly 225 million to nearly 288 million in 1 year. Stock-based compensation jumped from $22.7 million to $220.1 million. That compensation reduces the need to pay cash today, but it transfers value through additional equity. Preferred shares and partner capital can also sit ahead of common shareholders or claim part of the project economics. Therefore, even if Applied Digital's campuses become very valuable, the return earned by today's common shareholder will depend on how much debt, preferred capital, and new equity was required to finish them. There are also some famous names around the stock. Leopold Aschenbrenner's Situational Awareness Fund reported owning 13.5 million APLD shares at the end of March 2026, then valued near $320 million. After the fund's public equity portfolio was sold to Citadel in July, however, we cannot safely assume that Citadel still holds the exact APLD position. Other reported institutional holders have included Hood River Capital, Vanguard, BlackRock, and Goldman Sachs. NVIDIA previously owned about 7.7 million shares, which gave the story powerful validation, but NVIDIA disclosed that it had exited by the end of 2025. Let us bring the entire story together. Applied Digital has delivered exceptional revenue growth, signed $36.2 billion of base-term leases, and secured direct exposure to the AI infrastructure boom. Operating cash flow turned positive, and the scale of the build-out suggests the company can become far larger by 2028. That is the exciting side. The uncomfortable side is equally important. The company still needs an estimated $11 to $14 billion to complete the portfolio. GAAP losses remain large, customer concentration is high, short interest is near 28%, and common shareholders face dilution from shares, preferred capital, and project-level financing. For a medium to long-term investor, my verdict is to wait for better operational evidence before making a large bet. I would want to see more contracted megawatts delivered on schedule, base rent revenue becoming a larger portion of the total, recurring margins improving, and financing occurring without excessive dilution. That does not mean the long-term opportunity is unattractive. In fact, the enormous CapEx program makes it clear that Applied Digital could grow significantly over the next few years. But how much of that growth ultimately belongs to today's common shareholders is still difficult to answer. For a trader, the current price may look more attractive after the fall from nearly $50 to below $30. The stock is trying to recover above its short-term moving average, and heavy short interest creates the possibility of sharp rallies. But the same short interest, high beta, and weak medium-term trend can also create brutal reversals. A trader would need strict position sizing, a predefined stop, and respect for the support levels. If you enjoyed this breakdown, please like the video, subscribe, and tell me in the comments. Do you see Applied Digital as the next major AI infrastructure winner, or as a great business opportunity whose stock price has moved too far ahead of the financial results? Thank you for watching, and I will see you in the next one.